Are you a real estate professional? That is a question that confuses the crap out of a lot of people. And what do you get for being a real estate professional? And is there a way around it so you can still take advantage of some of the amazing tax laws that real professionals get when owning real estate? This is the Landlording Show. I'm your host, Tim Harstead. I have experience managing over 300 properties on the Chicago South Side, and we do it for investors, making their properties pain-free and profitable. And we are here to share our advice on how you can do the same for your properties. On today's episode, we want to talk about one of the number one ways that real estate investing makes you money. That's actually by making you money. It's actually by saving you money on taxes. So we want to talk about, one, what is a real estate professional? Two, why does it matter if you're a real estate professional? And three, I'm not a real estate professional. I can't get there. How can I still take advantage of taxes when owning real estate? So first, let's talk about what the tax code allows you to do in real estate that's really cool that doesn't do anything anywhere else like this. So we can take a loss on paper in real estate, meaning that we didn't actually lose money in real life. We didn't actually spend more money than we brought in. However, by depreciating your investments, you are going to record a loss on paper. And you can either do this the slow way by dividing the value of the property by 27.5 and taking that per year, or we can go ahead and get a cost segregation done on your property and then accelerate that depreciation and take even more. So we bring in $10,000 in rent and we pay $5,000 in expenses. So in interest and in maintenance and property insurance, we're going to pay $5,000. We're just making life easy on the math side. So we have a $5,000 profit right now. But we are going to take about $500,000 and let's say $400,000 of that is the actual value of the property. We're going to take, what we mean by that is we're going to take out the value of the land because you can't depreciate land. You can only depreciate the property. So the property itself, we were to pick it up and move it to a different place, is worth $400,000, let's say. So we're going to divide that by 27.5. And we can depreciate $14,545 off of that property if we just do straight line depreciation. So what that means is we made $5,000 in rent collection minus our expenses, but now we're going to depreciate $14,000. So when we do that, it's going to show a loss of $9,500. Okay. Now here's the cool thing. If you're a real estate professional, let's say that you made $100,000 in your other job, but you also are a real estate professional. You can now deduct that $9,500 from your other job's income and now only pay taxes on $90,000 instead of paying taxes on $100,000. But we can make it big. We can do a cost segregation, and by doing cost segregation, we're going to say, hey, look, the whole $400,000 might not be depreciated for 27 and a half years, but the roof only has 5 more years left in it. The dishwasher is only going to last 5 years. The carpet's only going to last 5 years. So those need to depreciate faster. And all of a sudden, now instead of $14,000, we're going to write off $70,000 of depreciation. And by doing that, our $100,000 of income that we'd have to pay taxes on at partially 45%, we're only going to pay taxes on $30,000, which is pretty close to the bare minimum. We're going to also write off our standard deduction, which is $16,000, and we're going to pay 14% of $14,000 in taxes. So that's roughly, so math times 0.14, $2,000 in taxes instead of probably close to 25 or 30. So it's huge savings that we're getting by doing cost segregation, by writing off the losses of our income. But here's the catch. You can only do this if you're a real estate professional. with two exceptions. Exception number one is going to be that you make less than $150,000 a year. If your household is less than $150,000 a year, you are able to write off some of your loss. Now, here is the catch. If you make over $100,000 a year, it starts to decline, and it's going to be between $25,000 or less of your loss that you can take. And if you're under $100,000, you're going to be able to take $25,000 up to $25,000 of a loss. So this is without being a real estate professional. You make $50,000 on your W-2, and you can show a $25,000 loss on your property. You are now only paying taxes on $25,000, saving on a huge tax. But if you make $149,000, you're probably only saving about, you could write off $500 of your loss. If you make $150,000, now you cannot write anything off unless, one, you or your spouse are real estate professionals. The other caveat or way around becoming a real estate professional is by turning your property into a short-term rental. If it is a short-term rental, then it is considered active income, and your losses now. It is considered active income, and your losses now will be able to be taken against your W-2 job, no matter what it is. If you're making $200,000, $300,000, short-term rentals are considered active income, and therefore you can take it against it. The big question is, all right, I make more than $100,000. I'm investing in real estate because I have extra money because I'm making $300,000. I'm making $250,000 a year. How do I become a real estate professional? So here's the good news is that if you have a spouse, only one of you guys need to be a real estate professional. So if someone is a stay-at-home parent, it might be worth making them a real estate professional. It might be a little bit easier because one of the rules is that if you meet all the requirements, you also cannot work more hours in a different field, okay? So the requirement number one is that you work 750 hours in a real estate field. And now let's go over those, what that could mean. So, or are you working in real estate? Here are the types of jobs that are considered real estate activity. I shouldn't say jobs, but things that you can do that are considered real estate activity. So real property development, redevelopment, construction, reconstruction, acquisition, rental, operations, management, leasing, and brokerage trade. Okay? That means that if you are selling real estate and you're working 750 hours, if you are actively working to acquire real estate, if you are out working on the construction side, whether that is meeting with GCs and walking through the property and supervising, or if you are the one putting nails into the ground with your hammer, you are now hitting your 750 hours through that activity. Now, here's the key to all this, though, is you need to report it somewhere. You need to make sure that somewhere you are recording your hours. Just like, everyone knows to report their mileage. If you have a job where you drive for your job and you're going to report your mileage, you need to record everything you do that has to do with real estate. So the best way that I do it is through my calendar. Everything I do is in my calendar. Doesn't matter if it is taking my daughter to the doctor or if it is going to a property to do a walkthrough or to show a new prospective tenant. It is in my calendar. I put notes in there. So at the end of the year, if the IRS comes and challenges me and says, you didn't work 750 hours, I can say, here's what I did for 750 hours that is real estate related. Now, here's the cool thing on 750 hours. It does not have to be on your own property. So if you are a real estate agent helping others buy property, those hours count towards your 750. If you are a construction worker and you are working on properties for other clients, that will also count towards your real estate professional. So we have the 750 hours. That is test number one. And one thing to be advised on that is all within one spouse. So it cannot be 350 hours for the husband and 400 hours for the wife. That's 700 hours for one person. But there's a second test we have to also pass. You also have to be a material participation test. So there's two ways that we can materially participate according to the IRS and be able to use our losses from our real estate to offset other income. Here's something, so there's two versions of this. One is if you own more than one property, right? If you own more than one property, and let's say you own 10 properties, or you own 5 properties. If you, and here's the cool part, if you and your spouse combine for 500 hours working on the properties that you own, whether that's leasing them out, whether that's doing floors, whether that's walking through, whether it's acquiring new properties, anything that you're doing that you're reporting activity-wise on your own properties that you own is going to count towards the 500 hours. And the nice thing, again, is it is combined. So your wife and you can put 500 hours into working on all your properties, and we'll cover all of your properties. Meaning you can take a loss. If you own 10 houses, you can take all 10 losses against your W-2 income. So here's a great scenario. The wife is working, making 200 grand a year as a doctor, and the husband is working real estate, and on paper can show a $100,000 loss through other properties. Now, between the wife and the husband has 750 hours in real estate covered, and then 500 hours between the two of them is $500 between the two of them is spent on the properties that they own doing activities to help them be a business. Those 500 hours combined now mean that they can take the loss on all 10 properties. Well, what if you can't spend 500? What if you can't spend 500 hours? What if you only own one property? There's not 500 hours worth of work, so what can you do? So there's a second part of this test where it is for individual properties. So if you own 3 properties and you work 100 hours on property A, then you can take the loss on property A, but not property B and C. If you work 100 hours on property A and 100 hours on property B, you can take the loss on A and B, but not C. And if you work 100 hours on all 3 of them, you can take the loss on all 3 without using the 100. And here's the caveat. No person can work more than your 100 hours. Meaning, if you hired Tom to do all the construction and he worked 101 hours on the property, you worked 100, then you cannot claim it. But if you worked 101 and Tom worked 100, helping you with the construction, putting in new floors for you, etc., then you're okay. So you want to make sure that you're using different people for different trades. That would be one thing I would expect you to have is, have a GC that you might hire one person for flooring or another person for plumbing, so that neither of them are working anywhere near your 100 hours on the property. You want to be the main person doing the work on the property. Here's the cool thing though. You don't actually have to physically do the work on the property. You can hire a property management company. What you have to do is be involved in the meetings with the property managers. So make sure that you are meeting once a month with them. Make sure that you are reviewing the financials of the property with your team. Make sure that you are doing some kind of activity at 100 hours per property throughout the year so you can claim this. Once you have that, and again, this is the great part about the participation thing is that you can combine both spouses' number of hours. So if the stay-at-home dad is also a realtor and is doing 750 hours in selling real estate, but then between the wife and the dad, you are at the property for 100 hours, doing 100 hours work on the property, you cannot take it. So now we have $100,000 losses. We, instead of paying taxes on $200,000 in this example, only paying taxes on $100,000 and are saving probably $45,000 in a tax bill, because at that point you're at the 45% range for that 100 grand and reducing your income to 100 grand. That's huge. You only collected $10,000 in rent in this example, but you're saving $45,000 in taxes. And this is why this is an important distinction. If you are going to be using a CPA, you need to use a CPA that knows real estate investing and is willing to help show you these ways you can save money on your income taxes. Because if you're not doing this, you are missing out on one of the biggest reasons why rich people have real estate. And that is so that they can stop paying taxes on their income. All right, guys, that's it for today. That's what I wanted to touch base on. We will talk again soon. Have a great time. If you have any questions, always comment below. Always let us know and we'll get back to them. And we'll talk soon.